Okay, so it's not really meant to be a primer on angel investing or primer on how to raise funds or anything like that. All right. So it assumes that you have your own methodology for angel investing, you've been building a portfolio, and then we move on what has changed, right? Because the truth is last 10 years we live in almost a very interesting environment, right? Okay, so about myself. AngelCentral started in 2018, right? Some of the partners there. What we do is we are helping angels in ASEAN become effective. Good angels, right? So good for the founders, good for their own bottom line also. So it has to be a win-win, right? Prior life together with Ning, I was a startup founder. This for the benefit of the non-members and the new members. A startup founder, so used to run a business for 14 years, right? Then we sold and retired in 2014. It's a job portal. Then after that, actually, I focus a lot on startup space, right, and focus a lot on education. These are the only two things I really devote time to, right. And besides my kids, yeah, and a dog. We just got a dog, right? But never mind. Yeah, that one's very interesting. Yeah, so I was a co-lead. Actually, a lot of the startup legislation and policies, whether in ESG or whatever you see, came from the Future Economy Committee, right? So I was on that committee and I was leading it together with this guy called Kopo Kun, right? So I think he's still a MOS now, yeah. So a lot of the policies like the VC streamlining and all that actually came from that committee. Then currently I'm board member of quite a few organizations. So like I mentioned, it's always either startup related or business related or education. And many startup board member, okay? And of course, we lead a lot of syndicates. So a lot of syndicate SPV director role, we are running it, right? So together with Xiaoning, we've invested around 8 million. I just did a count, it's almost there, into different 48 angel investments, mostly in this region, and then 7 VC funds. Okay, so this is our personal investment on that. So it's quite a significant chunk, right? And it's something we find meaningful. So like I said, this is not an angel investment 101 workshop, so I can't go into much into the reasons and all that. If you are curious, you can come and find out more, or you can join us as a member, then you will see a lot more of how we do the investing. Okay, but I do look at the questions that the attendees have asked. So I think need to cover a little bit about angel investing, how we actually do the evaluation, and then what has changed from there. Okay, the focus is on what has changed. All right. So far, so good. Okay. Can I just get a quick sense? I see a lot of familiar faces, but how many are members? Okay, so members are all active angels. I see familiar faces. How about the rest? Yeah, maybe some. How many are actually active angel investors you have invested before? Okay, 2. How about the rest? Founders, are there founders here in the room? Oh, okay, we've got a few founders. Yeah, he just started another one. So we have 2 founders. Then how about the rest? How about 2 of you? And enablers. Okay, it's part of the ecosystem lah. So you legal help or helping them to find deals or things like that. Okay. How about behind a few more, or maybe this gentleman in the Puma shirt. Yeah. How did you find out about us? Internet. Okay. And it's just curiosity, or are you in the space also? Curiosity. How about the lady behind? Oh, VC. Okay. How many of you are VC related one? That's why you're here. Oh, only one more. Okay. All right. Okay. So we have a very diverse group. Oh, yes. Okay. Oh yeah, I forgot. So the online one I need you all to help me because there's another 10 of them also right online. Yeah. So okay, yeah. So if there are things they're asking, please just let me know. Okay. All right. So today we'll cover like that. Probably take around 45 minutes, right? Then after that, we have time, half an hour for Q&A. So whatever you all want to know, we're quite happy to share. Right. If you want to trade notes on how you are adjusting your portfolios, I think that's also interesting. So today I will just cover how we evaluate, because there are quite a lot of people ask us, so as an angel, how do you go about evaluating in the first place? Okay, just very fast. Then I think we'll cover more what has changed in the last 2 years. Actually, a lot has changed in the last 2 years. Okay, quite dramatic actually. It brings me back to early 2000s. So I'm 48 this year. So I actually started a business with Ming back in 1999. So we actually saw the first boom and crash, but we caught only the tail end. We saw mostly crash, right, based on our experience. Then we saw another crash in GFC. Then we saw the crazy liquidity boom for the last 10 years. So much so that we also in a sense, kinda caught up by the whole thing, right? So I'll share more. So that's the macro level. Then we share a bit about how we see founders, how they are seeing things now. Right, there are some changes, quite significant, right? But also there are some things that are not changing, right? They still think it should be this way. Likewise for the VCs, we've been attending quite a lot of the VC fourth quarter and full year summaries, right? So because we invest in a lot of VC funds, right? So they have been shared, the GPs have been sharing, their thoughts on how they are reacting to this new environment, right? And then of course we go back to really the ground, which is where we are at. So angel investors, we invest very early stage. Okay, so we invest pre-seed, meaning you don't even have your product. To seed, you have your product, barely a bit of traffic, a bit of revenue, to maybe Series A, whereby you are trying to scale, hit your first million, hit past your first million. That's usually the 3 stages of a company whereby we are investing in. So to some extent, it's a bit insulated from what's happening at the ground that's very well publicized, right? The ground that's well publicized is the listed markets, right? You see the listed stock, wow, Carvana dropped 95%, right? ARK Fund dropped 70%. Those are publicized, the whole world knows about it, right? But what's actually happening, what we are seeing, right? And of course, we are a limited set of data points, but at least we share what's happening and then what's happening on our own portfolio. Okay, so just to recap, this is for the benefit of some questions were asked, right? So they're asking, hey, how do we even go about evaluating? I thought it's quite useful to just recap. As angel investors, we invest very early, right? So when it's so early, actually, what can we see? Hey, hi, Gideon. Hi. Yeah, just in time. Come. You can grab a coffee. It's kindly sponsored. Yeah. What's your company name? Wait. Wake the Crew. Oh, Wake the Crew. Okay, help you publicize. Wake the Crew. All right, thank you. Yeah. Yeah. So we invest so early stage. I think you've asked any of our angels here. End of the day, right? It's all about the founders, the people we are investing in. Right. If I have to put a percentage to that, I think it's 70-80%. Really, I used to think maybe 60-50. No, I think in the end it's 70-80. Because you get that person right? Even if the original model don't make sense, they will tweak it until it makes sense. Right. So when it's so early, there's so little to look at. I think people is the single most important factor. Okay, so a lot of people ask us how y'all pick. So I think it boils down to we pick based on the founders, right? And of course, the founders is more complicated than that. It's usually not one person, it's a few people. So we look at the interplay of personalities, the interplay of skill sets, right? And things like that. Okay, then the second thing we look at, right, is then we look at the context and the opportunity, meaning that is this a rising tide business? Right. So for example, if you look back in year 2000, right, when we started our business, there were still these things called newspapers, which I know they're still around, but very little people read already. And then in the newspapers, they used to have huge sections called classifieds, whereby all the property ads, all the car ads, job ads are all there. You'll be amazed. We counted last time. SPH used to make almost $200 million per year selling those classified ads. 200 million back almost 20 years ago, right? So the rising tide that was lifting our boat was that there was a huge migration of advertising dollars from print to online. That's simple. So what we mean by context and opportunity is that besides the people, besides the founders, the second thing we look at is if the context is a rising tide, right? Or for example, in 08, 07, if you invested and looked on the idea that mobile will be first rather than web, you'll be amazed. Before 07, 08, before iPhone came out, everyone accessed stuff through their PCs and laptops, right? It's only when mobile came up and the app stores came out and the Google Android store came out, then everything started to move, right? So again, that's a rising tide. So if you invest in a rising tide business, chances are you're going to grow well, right? So there are many other rising tides nowadays, right? Like AI is one rising tide. Recently, this ChatGPT, I just downloaded it to play around with it because I see whether it really kill Google or not. I got a lot of Google stock, right? So that's something. So context and opportunity. The third thing then is, of course, the execution. You look at the team you thought is good. The context sounds good. But if, for example, it's a seed or pre-A deal, they've been around a year. What have they done with this 1 year? Right? Did they deliver a lot on the product? Is it really impressive? So usually we like to ask if you have spent $500,000 building your product, and your product doesn't look as good as, because we see so many deals, right? Someone who spent 200,000, then our question will be, everything looks good on paper, but why can't I execute? Right? So these are the interplay of the factors, right? And if people is strong, context opportunity is strong, and execution is great, usually the angel will invest. Or at least our type of angel will definitely invest, right? The deal matters the least actually, right? Unless the valuation is so crazy. right? But now the deal starting to get us to think a bit more, because the problem is now, which leads me to my next point, which is what has changed, right? Okay, so what has changed is that, okay, so what has changed from 2021? So 2021 was the peak, if you all remember, right? Nasdaq hit, I think, 4,000, right? 4,000 or 4,008. I keep getting mixed up with S&P, right? So S&P is 414 now. Yes, Nasdaq hit around 4,004, correct? 4,004, 40,400, right? So it's 20 over percent down now, right? And then the S&P also hit a peak of around 480 SPY, and is now it's currently 410, right? So it had a huge crash, right? And what was the reason for the huge crash, which has a lot of implication on business, especially startup business, right? So what was the metric that started it all? Right? It's inflation, right? I think now we hear the word a lot already because it's very much in our face. Okay. So what happened? The metric that started it all is actually inflation started rising, right? Pretty anticipated, but then all the economists thought that they used this word transient back then. Back then, now no one dares to say it, right? So all of them thought it was transient, COVID induced, right? Because COVID, all the government started spending money, they were inflating, keeping their economy inflated, right, through printing money and all that, keeping interest rates at zero, right? Then what happened was, when COVID starts to open up, there's a burst of spending. So, but they all expected this burst of spending to disappear, right? Even the supply chain problem, they didn't expect China to permanently stay closed for so long, right? And of course, they didn't expect certain other things. So in the beginning, everyone thought it's going to be transient inflation, right? This is 2021, you can see, transient, right? They thought, oh, it's going to be for a while only. But before you know it, it was very sustained and it started going higher and higher, right? And but in 2021, no one still cared. No, if you remember, 2021 was the year of peak valuations, right? If you are in a tech space, you will know second half of 2021 it started dropping. Okay, there were shaky hands, but it's not a serious drop, right? People were just maybe taking profit. The really smart money was like, okay, maybe should get out a bit already, right? There was some tech re-rating, but not in a big way, right? It started accelerating in fourth quarter 2021. But the one that hit the fan is what's the one that really caused everything to, result in the very bad 2022? Anyone? What happened in 2022? Huh? Ukraine. Yeah, that was the one, right? Suddenly there was a pure wildcard event, right? You call it Black Swan event. That one not anticipated because people anticipated COVID. They anticipated the rebound in spending post-COVID. In a sense, they also can guess China would stay closed, but that one also a bit surprised to a lot of Western world. The developed markets didn't expect to stay closed so long. Everyone thought it's inevitable that they would have to open, right? But they did it for a full year and a half, right? I think, yeah. Okay, so what was the thing so the metric was this, and then it triggered, and then this is what happened, right? Interest rates started going up because this is the main tool that the Federal Reserve, which is the US government's monetary policy, right, has to control inflation. This is the main tool they have. So the best tool they have is to keep raising the cost of funds, right? And you keep raising the cost of funds, companies will spend less. They have to redesign all their investment plans, right? CapEx gets shelved. All these things will result in slowing down of consumption, right? Which will then reduce inflation, right? That's the theory. And it does work, but it took them a long time to make it work, right? If you remember what happened in 2022, we started the year at almost zero interest rate, right? And this is all American, because in the US moves the world, okay, right? So it was zero back then. By end of the year, it was around 4%, right? And then they recently just jacked up again, right? Another quarter point. So this is the fastest in history, by the way, right? The Fed has not done this before so quickly. I think 1%, 8.75, 0.75, right? Yeah, 10.5. So what happened in the stock market becomes like that, right? So once money has value, it's no longer easy to just leverage out and fund companies, right? That's essentially what's happening, right? So because last time I can borrow money and at almost zero, right? And then I use it to invest in startup, I use it to invest in bonds, I use it to invest in anything. So all the asset prices inflate. And this thing went on for a very long time. It went on for 10 years. Post GFC, the Great Financial Crisis, 2008, 2009. From 2010 onwards, it was a one environment. So actually, it's quite worrying. A lot of our younger colleagues and younger investors or professionals, you have only lived through a pure liquidity boom. we have not actually seen a crash before. You've seen crash, but not a high cost of capital environment and high inflation environment. So we were also quite shocked. We had to keep thinking and start reading the historical what happened in the past, the 70s stagflation, how things behave, right? And we come to some conclusion, don't know right or wrong, but we can share. But essentially, the first thing will be all the loss-making stocks. So you can see it really happened already. So some of you will be wondering, how come our startup still valued so high? Yeah, I also asked the same question, right? Because on the listed side, they all crashed dramatically, right? ARK, which is the poster lady by this fund manager called Katie Woods. She's the poster lady for hyper bullish growth stocks. Almost everything in the portfolio is loss-making except Tesla, right? So it crashed, right? It crashed dramatically, 70+% crash. This is QQQ, not so bad, 30% crash. QQQ is NASDAQ 100 companies. Okay, so a lot of growth companies inside here also. So this one bad, this one 30% crash, this one lucky worse, this one 70% crash. Right? This is the ARK fund. Right, so this is a direct result of interest rates going up. It's almost mechanical, right? Because you imagine for a rich person or for anybody with capital, right? Why would you bother trying to earn 8% or 10 or 11 or 12% return when I can get 5% or 4% borrowing money, lending money to the US government, right? Then you just cascade it, right? The entire risk reward, right, changes for everything. That's essentially what happened, right? All the risk reward for all the different asset classes have changed. So what happened, right? We discussed it a little bit. So 2021, second half, right? There was a lot of COVID supply chain issues, overvalued growth stocks. So there was some selling. People were anticipating, Fed going to start to stop buying so many bonds, right? Fed going to maybe even raise interest rates, right? Some more sharp people will be like, hey, this inflation could be here to stay for a while, right? So there was some sell-off. And then actually, but the broader market was fine. If you look at the FANG stocks, they were all still quite okay, right? Because the FANG stocks are super profitable. They are a bit different from your usual Carvana or name them Snowflake, whatever name the whole lot of all the growth universe stocks, right? But what happened in first quarter, as you point out, is when the Ukraine war came, right? Oil prices spiked, all the commodity prices spiked, right? And then it didn't help that China showed no sign of opening up, right? And then there was this whole, they call it a bifurcation, right? Splitting of the world economy, right? Between China and US, right? It's because both of them now see each other as strategic long-term rivals. So they want to build their own ecosystem of everything. It's not quite possible, but they are trying, right? As much as possible to hold each other back. So that, of course, result in more costs, because whenever you do different supply chain, you break things up, right? So you hear of companies say, I used to produce all out of China. Now I'm forced to have a plan to produce partially in India, right? Or that's why India is a beneficiary, or maybe even Southeast Asia. So what we are hearing is that it's half true. There are plans created, but real investment still not, but it's only been a year, right? Yeah, so we don't know, right? But all this will increase cost of production, which then drives to inflation, right? So that's why inflation started rising, right? And of course, inflation has a bit of self-fulfilling policy thing, right? And then the other one I learned recently was from this UBS chief investment officer. I was listening to one of his talk, and he also attribute all the inflation not just to supply chain related. That means cost of material, cost of logistics. He actually linked it up, and he thinks it will be long lasting because of wage. And I think he's totally correct. You look at the US unemployment numbers, they're very low. You look at Singapore unemployment numbers are freaking low, especially right. In fact, we are total shortage of workers. And if you ask the normal guy on the street, everyone still did well last year. You only do badly if you own a lot of assets, other than property. If you own stocks, bonds, private equity portfolio, you lose money. So who has these three? Only the super rich actually, right? Your normal person in the street actually had an increase in pay, anything from 5 to 15, 20%, because it's inflation, right? The government set the tone. So actually, if we look at our shops, there's so much consumption going on, right? Middle tier, right? So much consumption going on. So, and the same thing this UBS guy was saying is happening in the US actually. That's why their recession, they anticipate to be mild, because the consumers are still spending and they are consumer-driven economy, right? So anyway, that's a side thing, but it has context, it's to set the context. So inflation started rising, and it's quite scary, right? We've never experienced inflation 7-8% like that, right? I mean, it's quite scary. It means your money is being eroded 7-8% every year, just like this, Of course, when the Fed acts so well, right? They really acted they were a bit late because they thought it's transient. Then once they realized it's not transient, they acted very fast, I have to admit. So to their credit, I think they seem to have brought it under control. There are some experts who say it's not. It will come back again as soon as the Fed slows down. We don't know. They are slowing down now, right? Now it's at 1 more 0.25. They're expecting 1 or 2 more 0.25 for this year. It used to be 1 more. Now the odds have changed to 2 more times, right? Which means we will end up around 4.75% for the Fed fund rate, right? Right. Yeah. So that is the situation. And then the result is, of course, all the stock market drop lah, and all the bond market drops, right? And dropped badly. So nobody was spared last year, actually. Last year, it's called a nowhere to hide year, actually. It's quite interesting, right? That there are a lot of, everyone was asking their bankers, so where can we hide? Then there's nowhere to hide except cash. And actually, there is for Singaporeans, it's Singapore stock market and property, right? The stock market went up last year, for Singapore. If you just bought the STI index, you're actually quite all right. Cannot buy MSCI in Singapore because that one owns C. They included C and Grab, and that caused a very bad crash, right? But if you bought the STI ETF, which is essentially all the banks and REITs, actually you're fine. Okay, and then of course you own Singapore property, you're laughing to the bank still right now. Right now, for now, right? So that's what happened in Singapore, happened in the world. And of course in ASEAN, right, not so bad for us, right? Because we have a rising demographic story, right? So when we read the news, you will realize it's extremely US-centric, right? Because they move the whole world and they are the biggest economy, right? But then sometimes we have to see and localize it to in Singapore. So like, for example, when earlier this middle of last year, we keep talking about recession, then, but we keep looking at Singapore, it doesn't look like we're going to go into recession, right? And then true enough, the government has come out. They say most likely we are not going to enter recession unless the US situation changes, right? And especially now with China reopened, we are fine. It's a boost to us. Okay, so, but what did happen was that our interest rates did rise in tandem, right? Because that's our policy, right? So our interest rates, I think if you look at use SORA as a proxy, right, it's currently at 3.5%, right? And it will move in lockstep with the US market, right? With the US interest rates. And we are in the same situation, right? Except that back in 2021, we had the added headwinds of China zero COVID policy because it affects us. Like tourism alone, easily 25-30% of our tourism receipts are all Chinese. They want straight away disappear. So that's why we are still below our peak. You can read. They will say, wow, we're doing very well back to pre-COVID peak and all that, right? But actually look carefully, we're still missing the Chinese tourists. But now they started coming back. Okay. And we had a lot of recession fears throughout 2022, but our stock market still plowed through, right? And people are spending. So that's the thing that is I think it's our bright spot, right? When we look at it, and we look at the startups, later I'll share you some data of our startups. Actually, a lot of them still grew revenue last year, right? Some, of course, barely affected, but most of them still grew revenue, right? So it shows that the consumer spending is still strong. The demographics are still strong. Corporate spending could be a bit weaker, especially those that are by default global, right? So global, they say cut, means the whole world needs to cut, right? Because Singapore is not important enough, right? So if they say cut, means we cut also, right? So it's quite interesting that way, right? So the result is we think in ASEAN, the consumer spending is still strong. Our wage increases are super healthy. You ask around, right? If you're an employee, it was a great year last year, right? There were a lot of approvals for salary band revisions, overall increments, right? And of course led by government, right? And our inflation now, just like the US, seems to be under some form of control already, right? Which is important. So how about the growth stocks, right? So the growth stocks, this is what happened, right? They are the ones that are worst hit. Okay, then followed by the companies that have been highly valued because they're super profitable, FANGs and all that, right? Then in fact, the ones that did better are the smaller SME listed companies, right? The value stocks, of course, commodity did fine. Commodity and utilities, I think, still gained, right? But this is what happens. So it's quite scary, right? So some of you, I'm sure, will own ARK Fund. Some of you, and I didn't mention crypto, but you can think of crypto like an even more crazy version of ARK Fund, right? So crypto, I think everyone knows the crash. So purely liquidity bubble, right? The amount of money in the ecosystem has to flow everywhere, That's why you can have NFTs prices surging and all that during back in the 2021 peak. Okay, so you can see C also dropped a lot. Carvana, which is like the equivalent of Custom Caro, dropped 95%. Right, that's why we always wonder, then what happens to Custom and Caro's valuation currently, right? How is it supported? Any thoughts? What do y'all think? How is it? How do y'all see it now? So I mean, I'm sure you know the growth market drop, but what do y'all think about the listed, the unlisted side? Does it follow naturally that if Carvana dropped 90% means Caro is worth 10% of what it was last time? Yeah, it's more complicated than that, right? Maybe they are still growing, they are growing much better than Carvana, right? Yeah, correct. And that's one of the things we observe, right? So if you have enough cash, the unlisted firm can maintain its valuation because they can push out that decision whether you're going to have a down round or not 24 months out. Then maybe 24 months later things have changed. So actually that's one of the critical questions. Do you think in 24 months later will interest rates stay so high still? Right? Are we ever going back to those old days whereby interest rates almost zero? That's an anomaly, by the way. It was never like that before GFC. Right? So it's quite interesting, right? If you're interested in this topic, okay, QQQ dropped 33%, SPY dropped 18. What do y'all think? Why it dropped so much less? So QQQ is the top 100 Nasdaq stocks, right? SPY is the S&P 500, the 500 biggest American companies, right? Why do you think they dropped a different amount last year? Still a lot, but why so much less than the growth stocks? Diversification, they are more diversified, that's true. SPY inside has got oil and gas companies, has got banks, right? Those are still fine. What other reasons? Yes, profits, because they're profitable. The ones that drop a lot are all unprofitable, which also unfortunately includes almost all our startup companies, right? They are all profitable. So if you remember, when interest rates are high, it means the cost of capital has gone up. But if you are profitable, it's today's capital. I get a profit today, right? Why people invest in growth stocks when interest rates are zero and why we love it so much is because it costs me zero to get capital to invest for future profits, right? It's quite interesting how it flows that way, right? It's a lot of people all acting and then somehow there's a certain trend that appears. Yeah, so it's because QQQ and SPY stocks are still mostly profitable. And QQQ dropped more because they got a lot of FANG inside. They got Tesla and all that. They are grossly overvalued, right? But at least they're still profitable overvalued. And then, of course, the bonds drop only 10%, which is still a lot. You ask any bondholder, drop 10% is a disaster, right? But that one is more of interest rate problem, right? Interest rate go up, bond price have to drop. There's no other way. There's a mathematical relationship. And then, of course, cash went up. So how about startup world? Okay, so I'm zooming in to startup world generally, and of course, focusing more on our region. Okay, there are only three good things we can think of for startup world, right? At least for near term, very near term, okay? The good thing is VC have money, all right? And I would add startups have money. A lot of startups manage to raise, right? They managed to raise in 2021, big round, more than enough cash, right? It's just whether they're going to waste it all away or they're going to hold it, make sure they don't waste it. So that's very important. So a lot of the founders' mindset now is to switch to cost saving, make sure don't spend too ridiculously, right? So VCs have money, startups have money. So that's the good. And our VCs, a lot of them managed to raise, right? They managed to close out the next fund in 2021. Some of them did it in first half of 2022, right? Now it's really hard, right? Since fourth quarter last year till now, we are hearing it's very hard for them to raise LP money already. Everyone just want to wait and see a bit more. But things move very fast because this is a capitalist world, right? So even now, the market, first month of the year, the market has rebounded a lot, the US stock market, right? And bond prices also. So because of that, it's quite possible that if this is sustained and you don't see any more scary statements from the Fed, it's quite possible that the LPs will come out and start investing again. Then you start hearing some VCs closing their rounds, closing their funds again, right? The other good is consumers are spending, really, right? So this is the one that's saving the world, actually. The US consumers are spending, Singaporean consumers obviously are spending, right? And then the other good thing is for us here, it doesn't look like we're going to have a recession, right? It really doesn't look that way. And it's because the US recession looks as though it's going to be very mild, right? And of course, right now, it looks as though the inflation is under control, but that's the weakest statement of the lot there, right? You don't know one. Okay, there are some very smart people who think that it's just temporary blip, right? It's going to come back again, right? Then that will be a disaster, okay? The bad things are plenty, right? So valuations have dropped a lot on the listed market side. On the private market side, we see a little bit, right? We are seeing some, I think our AngelCentral data show that some 20-30% drop, even at Series A valuations, right? Series B and C, probably more, right? But a lot of them are supported because the first point, VCs have money, so they are supporting their own companies. So for example, if I'm a great company, right, and the VC maybe funded my last round at 100 million, what's happening now is that the VC is carrying on to support me so that I have my runway of 24 to 36 months, right? And they will give me at the last round. So it's very friendly terms, right? And that's what's happening, right? Then if my current VC don't want to support me, then I'm in big trouble, right? Because then I probably go out the market right now, confirm it will be a down round because people will be looking at the listed comparables. Okay, so valuations have dropped a lot on the plunge on the listed side. On the unlisted side, it's still playing out. It's always slower, right? So we invest in some PE funds also. They are writing down their numbers somewhat. The VC is also a little bit right down here and there, but not in a large number, not in a big way. Okay, the other bad thing for startup founders and startups is that costs are rising like crazy. And this is directly inflation, right? So a lot of startup founders have to pay all their staff 5 to 10, 15% more this year. Last year, sorry. Right? Because it's hard. The whole market is going up, right? You can't don't do it. If you don't do it, then you just lose your staff. Right? This is of course counterbalanced by startups that lay off, then there's a bit more labor in the market, right? But I think in Singapore generally we are so tight, it's quite bad. Okay, a lot of investors are wait and see also. Second half of 2022, I think a lot of investors wait and see, right? There were a lot of VCs that didn't really actively invest a lot. If you just go and check the amount of deals, everything has dropped, right? 20%, 30% in terms of deals being funded. Okay, and then in 2023, right, which is this year, very small chance of exits unless the whole market turns around in second half of the year. So we attended a lot of the VC year-end LP meetings, right? Most of them are telling us that there's no distribution this year, right? They're warning all the LPs, highly unlikely there'll be distribution this year. Meaningful distribution. Small distress one because they sell off something, of course, but meaningful one. That means all the IPOs, Credivo was supposed to IPO. That's what a huge buy now, pay later digital bank in Indonesia, right? Ninja supposed to explore, right? Custom was supposed to do spec, right? All put on hold already, right? And the earliest they're going to do is 2024. It's highly unlikely it's 2023. Okay, so that means that everybody got to wait one more year, right? And I think if you get any exit this year, chances are the valuations will be bad. Okay. Corporates, the other bad thing is, like I mentioned, a lot of MNCs are deferring investments, right? They are cutting back. The overall HQ tone is cut manpower by 15% or 5%. So of course there's the weakness there, right? And of course corporates are tight. So this is the environment that's happening, right? And there are quite a lot of mindset changes we observed, right? So in 2021, right, if you are a founder, really, and it took us a long time to come to terms with this, but they are not wrong. So in 2021, the founders always think, hey, I just sell my vision, right? So the good founders that raise 10, 20, 30, $50 million, right, always vision and dream one. Very charismatic, very strong salespeople, right? And for them, they are not wrong because it's so easy to get funding. It is the best form of financing. It is stupid, right? If you are building a high growth company, right, to try to finance it with debt or to try to finance it with revenues, it's actually stupid, right? Because the logical thing is to convince somebody who has already raised $500 million to give you 50 million, right? And the valuation is in your favor, no? Right? So that was the founder thinking back then, right? And because of that, of course, they have to deliver on growth, which means revenue, right? So they drive revenue at all costs. That's why you hear of companies growing ridiculously fast, but the numbers are just bad, right? If you look at it from a profit standpoint, right, are just bad, right? It can be expanding losses, but then the top line is growing a few 100% a year. So those were popular back then. Profits don't matter at all. That's the truth, right? Nick and I don't like to see this, but I think pre-2022 was like that. And the thinking was really spend first, optimize later. So we had some startups. We asked them honestly, how come back in 2020 you do X revenue, you lose money, lose something like that. Then now you turn profitable using the same amount of revenue, right? And they were very honest. They told us, yeah, because back then I wasn't optimizing. I just want to grow my revenue at all costs, right? So because what does that mean, right? That means you just hire the expensive hire, right? You load more people than you really need, right? Because you're anticipating that I'm going to keep growing. You slash prices to get sales. You open new markets to get sales, even though it's not efficiently run, right? You will do a lot of actions that are driven because capital is very cheap, right? That's what was happening. Then in 2022, what happened is that, yeah, they realized, oh no, this is not transient inflation. All my costs are going up, right? And most important, listed markets are crashing, right? Because once listed markets are crashing, then everyone tighten. There's a whole cascading effect, right? From the listed, you'll cascade to the private market, to the late stage private market, and then now it's still cascading, it's still not done, right? It'll cascade to the early stage private market, which is where angels and all the early stage VCs are. And of course, little trade sales makes things worse. You got no exits, right? No recycling of capital. And there's one smaller point. A lot of our startups don't really have debt, so that's not so bad. But cost of debt is getting heavy, right? Because now if you want to borrow money, I heard of some startups. There are quite a lot of invoice financing startups, right? They are a platform, and then what they do is they will usually create a sidecar, a side vehicle, whereby that's where people lend money to that, or invest money or lend money to the side vehicle. Then this platform uses that money to lend to other people, right? So last time this used to be in Sing dollars. If I give 6 to 8% to the person who invests, is good enough. But now with this new interest rate environment, you got to give 12, 13%, right? Then does that make your original business, your platform side, is it viable? Right? So that's something everyone has to ask. If your business relies a lot on debt, right? If you are lending money type, you have to ask your cost of capital, how low can you get it? Especially now that it's so high, right? So currently, when we talk to a lot of founders, I think the thinking has changed. So that's good for our ecosystem, right? A lot of our founders, they do get it, right? The time we were meeting with the carousel guy, yeah, they're all talking about cost cutting, right? So a lot of them had to defer their exit event, whether it's an IPO or a SPAC. A lot of them tried their best to raise enough money for 24 months. So if you see Shopback, they very cleverly raise money, right? So that they have enough cash to tahan as long as they can, right? They of course have to cut costs. That one no need to say, right? If you look at the way C cut costs, it's quite scary, right? We are hearing amazing, even the Lion City sailors also cut the allowance to that extent, right? So they're really cutting. They own the Lion City sailors, right? It's a football team. So apparently they used to pay 1,500 a month stipend, it got cut to 500, right? For the student team, for the youth team. Yeah. So that's good. That's what I like to see, because that's real business, right? You cut when you really need to cut. You don't do half-ass efforts. And so everyone's trying to right size for the markets, right size the geography, so you can see exit so many places, right? All the European countries they exit. So it's happening to a great extent across the entire ecosystem. So that's the founder thinking, right? On the VC thinking side, you can see there's a lot of slowdown in investing pace, right? Especially in the second half of 2022. They say 2023 they're going to start again. Let's see, right? Let's see whether the funding moves or not. A lot of them spend time working with their portfolio winners, so they have to coldly look at all the portfolio companies they have, and then find which are the winners, the ones that are delivering the fund, right? The ones that will deliver all the profits to all the LPs, and then they will spend more time on them and spend more funds on them, right? So they have limited funds. So remember, I was telling you, right? So for example, if you have a great company, but they only left 9-month runway, right? So they will decide, okay, maybe this is the one, this one can carry on, rather than ask them to go out and get funding in this climate, which is almost certainly a down round. Why don't we just add another 12 months to them, right? So at first, when we heard practices like that, Ning and I we are very idealists. So we heard practices like we thought, wow, that's such a cheat, right? It's cheating, right? Why are you doing that, right? Because you're just bolstering up your own valuation. Why don't you just be honest and have a write down? But I think we are too idealistic. If I put myself in their shoes, this is actually the smartest move to make. It's the logical move, right? I push it out 24 months. Best case or average case, there is an exit event or there is a new round. After that, the whole crisis is over. I actually managed to make my fund look good the whole 24 months, right? What's the worst case? The worst case is it doesn't work. It's still as shitty 24 months later. Then I write down then, right? There's no loss to me. From a VC partner point of view, that is the smart thing to do, to maintain the valuation and just push it out. But only for winners, right? If I do this for the losers, then I'm giving myself trouble, right? So that's what they all are doing, seriously, right? And then they are managing LPs, so like I told you, almost all of them told us no DPI this coming year. right? IPOs will push out to 2024 or 2025. Um, because our ecosystem, some of the funds started as early as 2013, 2014, so they're actually 10 years old already. They have to start giving back the profits to the investors, the LPs. So a lot of them say they will explore secondaries, but I don't think it's very easy, lah, right? Bad market means bad market. It means you can't sell, lah, that's all. Right? I mean, otherwise how? Unless you search for long, high and low, lah, for somebody. The interesting question was, do profits matter? So I thought logically in a climate like that, and if you look at the listed side, the profitable companies are the ones still maintaining their value. Logically, I would have thought all the PE VCs would say profits matter. So I'm wrong, right? Very clever VCs, and I can see their point of view, have shared that they actually think it's still, they will rather their portfolio company still grow revenue as a priority, but not with a bit more conservatism, meaning that don't care, don't have expanding losses, right? If you can have narrowing losses, but your revenue grow even faster, it's still better than you have barely any revenue growth, but you turn profitable, right? So that's their point of view. And I don't think they are wrong from their point of view, because they are seeing at 24 months out, when I want to do the IPO or trade sale, it is scale that matters still, right? So it was quite cute, because I had one very good friend, they own a very famous VC. So he was telling me that, we're having these discussions in the board now. So do we scale down all the way and then we squeeze out 1 million profit to show everyone? But if 1 million profit, you value me at 40 times, it's just a $40 million company. I might as well grow the revenue more and just make sure the losses don't grow too much. He's not wrong. So I think, right? He's not wrong, right? So do profits matter? That's why I say mixed views, huh? And you can share what you guys think. Yeah. And what we are seeing on the ground now, so we have some AngelCentral data we dug out for everybody, right? So last year, in terms of volume of startups we see, so now please remember, now I'm going all the way to really early stage, which is Angel. So Angel, I must say, we are still very insulated. No? Not that much has changed. You can see, okay, this is what we are sharing. The volume of startup, number one, we still see roughly the same number. So that's good for Singapore, good for our ecosystem. Founders are not saying, I don't want to do founding anymore just because the environment is hard. I don't want to be an entrepreneur anymore. No, lah. I think they still want. So that's great. Of course, if this is prolonged, you may see it drop, lah. Right? Because I think if it's really prolonged, really bad, there will be less people that want to do the entrepreneurship thing. Quality, we still see very good quality, actually, I must say. Right? I mean, I've been in this market for 12, 13 years. If you count my AngelCentral days, then 20 over years. I think the quality of people entering tech as founders keeps improving, better and better people. Angels last year, at least at AngelCentral, the amount invested actually dropped by 20%, right? I think last year we funded barely 5 million. Previous years was around 6 million as a group, right? So there is a drop, and I think we are probably quite reflective. And in fact, when I share this number with some investor friends, they're saying that this is a lot less than they expected. They expected it to be even worse, right? And we had 13% less angels cut checks. So some people actually just don't cut checks anymore last year, right? Because it's very individual. I mean, if your stock market drops so much, right, then maybe, or maybe they will let off their tech jobs, right? So less people cut checks. And then actually we had quite a lot of A rounds last year. The valuations were all a lot lower than what the founders wanted, right? So we had some startups, the founders did convertible notes at 30 million cap, right? The actual funding was done at around 20, right? So and the founders still took it. It was a good VC and all that, right? And they recognize that the market has changed, right? And by the way, I think it's fundamentally changed for a while, so we will see. And then the valuations are more negotiable, but it still hovers around the same. So there is this idea that, when we invest at seed, right, it's already very low. It can't go too much lower. There is some truth to that, right? So I remember when we first start, valuations are maybe 2-3 million Sing dollars, right? And this is like 20 years ago, right? So if once you account for inflation, it's reasonable that nowadays it's maybe 3, 4, 5 million dollars, right? How much lower can it go, right? So there is that factor at play, that at seed it's kind of hard to cut anymore, right? Which I agree, it's a bit hard anymore, right? But at Series A, we are seeing quite a big cut already. Our own portfolio, so Ning and I, this is just for two of us. Maybe later Timo can share, or Sarah will share a bit, right? Our own portfolio, we in 2022 actually not that bad, no. Overall, of course, IRR still dropped. We had a 30% IRR originally at end of 2021, but it dropped to around 24%, right? It's a very long story, but it's colored by some of the early investments that weren't so good lah. We had one exit actually, but it was in the first half of the year, and it was a good exit. And when we asked the founder, um, um, how did this happen, right? It's because the deal was talked about as in late 2021 already. So that's why it's this company called One Animation. It's quite a big exit, more than 50 million US, right? So quite a good company, right? Profitable thanks to COVID. And yeah, so this one a bit of luck. Then we have two that highly likely will fail already because of 2022, right? Different reasons, not because of interest rates by itself. Of course not. That's seldom the reason, right? It's because travel, COVID related, and all this kind of thing. We have three with less than 12 months runway, which we are a bit concerned. So we are watching to see what they're gonna do. And amazingly, we had six that raised higher round. So it does tell us in a sense that number one, the idea that in ASEAN we are a bit more insulated because we are not really in a recession and our demographic story is strong. It's actually quite true. There is even when we ran our business, right? GFC, right? AngelCentral grew 11% during GFC that year. Yeah, record profit because government gives so much grant. Yeah, no, not grant lah, but government gives so much job credit. I also got job credits back then. Yeah, no, so in a sense, the dynamic here is a little bit different. So the issue is when we read the US news, you read the China news, how do you then combine it with what we are seeing here to come out with a thesis, right? Yeah, so six of our companies got higher round, 12 of them improved revenue, right? Yeah, so by more than 20%, I mean, it's real increase in revenue, not just small little bit, right? So it does tell us one thing, which I feel strongly, that early stage companies, a lot still depend on the founders and the execution, right? The macro thing is like a bit of a backdrop, but you get a great team, great founder, worst recession also, they will do very well, right? Because they are starting from a small base. They are not the market. If your company is the market, then it's different. Then they are of course affected by all the macro, all the demographics. You know what I mean, right? If you are the 80% market share, of course, whatever happens in the economy affects you. But if you are the 1% market share or the 0.5 trying to grow to 2, nothing, right? And from 0.5 to 2 means you 4x, right? So I think there's that thing that we must remember. On our VC side, we invested 7 VCs. You'll be amazed how bullish they are. They actually increased the TVPI for us. And that's why it got me quite not say agitated, but I was asking them for real or not, right? Then I realized it's because there's no new round, they don't write down, right? And it doesn't make sense for them to write down. Which VC will write down? If you write down, you're gonna have difficulty raising your new rounds. You can answer a whole bunch of LP questions. You might as well just stick to the rule book, which is that no new round, keep it at last value, right? And then if you couple that with them funding their own winners using the same valuation, then of course there's no down round, no write down in VC funds, right? So I think it's totally fine, totally logical, but the only caveat is that this climate or the companies they own must turn around, must do well, then it's fine. But because it's a bit like kicking it down, kicking the answer to 2 years later and we see what happens, right? But they are right. If I'm them, I'll do the same thing, right? It's logical. So some comments when we analyze our own portfolio. The good thing is there are very clear drive from startup founders to longer runway. Nobody is talking about growth at all costs anymore. Nobody is talking about, trying to raise crazy money to do crazy stuff. A lot more grounded, all the discussions, right? There is very clear cost problems, right? Inflation-driven pay increases are very real, right? Imagine if your EOM, your expenditure on manpower is around 50 or 60%, then everything went up by 15%. Oh my God, right? How to show narrowing losses, right, in a market like that. So they have to do it by revenue growth, right? And it's hard for the majority, but I think good companies will stay good even in a bad environment. So good companies are still growing. Like we say, if you are like us investing very early stage, your company doesn't represent the market. They are usually taking it from some incumbent, right? Or they're creating some new category. Then of course the sky's the limit, right? Even in a recession. But having said that, valuations have dropped. That one is clear. A-round valuations, we see it drop 20 to 40%, right? Internal rounds, at last round, right? Once they cannot raise externally, they will do internal round at last round. If you see those doing internal round at down round, that means really distressed already. That means their key shareholders are not backing them, right? And it is happening. There are some companies like that. Yeah, and then of course we analyze the VCs because they are the ones that move the market, not us. We're just angel investors, right? We invest early stage, then they take over. They are doing what's logical for them. So in other words, if this situation stays on for a few more years and recession really is in Singapore, then you will see a write down in some of the VC funds, right? They are not writing down yet, right? And then once they write down, then there'll be more repercussion already, right? So our conclusion is that the early stage startups, they start from very low revenue base. So execution matters the most, right? That's why we are continuing to invest, right? And also we are so far from the exit event, right? Normally, if you invest even Series A, there's still a good 8-9 years for it to grow. Look at Ninja Van, how long the story from the time Mang Seo invest, right? Mang Seo invested in 2014. It's 9 years old already, still haven't exit, right? So we are getting impatient because we invested in Mang Seo. So a lot of us are getting impatient. You're saying, when's the exit? Because this is the fund winner, right? So the answer is yeah, have to wait, have to wait for public markets to be fine, right? So looking ahead, right, how we see things is that okay, this one more personal, right? Because I do a lot of investing on my own on other things. So the base scenario I have is that I think the inflation will be brought down to under 3 in the US, but it may not happen this year, right? Right, because we suffer from, we will benefit from a high base effect, right? Because last year, right now, still not that high, but if you go till June or May, last year inflation was 8%, 7 plus 8. So this year obviously will not be 7 plus 8 on last year 7 plus 8 one, right? So you will benefit from a high base last year, and by default it should drop, right? If it doesn't, then I think the shit hit the fan already, right? And because of that strong consumer spending, wage driven strength, right? In spending, the US recession is expected to be very mild. In fact, we don't expect recession in Singapore, right? ASEAN countries are all fine, mostly around us are okay, right? China is supposed to open and rebound, so let's watch. The market really rebounded like crazy. If you invest some Chinese stocks, finally, right, all the Alibaba and Tencent are moving. But interest rates will stay high, right, at 4.5 to 5.5. This is Fed funds rate. So Singapore, SORA 1% down from there. And it'll probably come down in 2024. So it does mean it's quite turbulent times, right? But in turbulent times, there's opportunity, right? And that's why we are carrying on to invest, because we think that it's the best time to look for new deals. It's also the best time to look at old deals that are well run and they need more funding, right? And the valuations can be very attractive, right? So personal adjustments, we made some adjustments. We discussed. So we of course will stay the course because we believe that it has to be a portfolio approach. Every year we pick 4 or 5 companies. Every year, right? We just keep investing. But we don't overpay, right? So we are quite conscious that we don't want to go crazy, invest just because some famous VC invest. So we are very careful investors, but we're also guilty of that, right? With 48 startups, I think 1 or 2 are less well-advised investments. We do want to look out for companies at very high gross margin, right? Or even profitable outright. So like if AngelCentral, some of our recent syndicates are actually for profitable companies, right? They already turn profitable. You invest in them, we feel a bit safer, right? At least they're not going to run out of cash anytime soon. High gross margin, if loss making, at least then there's a clearer path and the top line doesn't have to be that high for them to turn profitable, right? The problem with those super low gross margin, high revenue growth is that you can be $100 million business, but your gross profit is just 3 million. Then how can 3 million pay for your HQ costs and all your other costs? Sure cannot one. So you probably need to be at least $500 million as a company, right? So we want to avoid those, right? Avoid anything that has debt. At least that's what I feel, because I don't know how it will play out. You know what I mean? So if I'm like, for example, those factoring companies, there are a lot of factoring companies, right? They are a platform. They help to lend money to SMEs, right? Because the banks don't do it well enough. Or they lend, or buy now, pay later. You lend money to consumers in a sense, right? But where's their capital coming from, right? It can't be your balance sheet anymore, no, because to the VC is like capital is 4-5%. I need to find it from somewhere else, right? So I'm not sure how this will play out. So I will rather watch first and see what happens to these debt-based businesses. Of course, this one is obvious, long gestation, high spend. I think this one's self-explanatory. Huh? Then we want to support existing portfolio winners. Those that we think are doing well, good entrepreneurs. If they need follow-on round, we try to still take about pro rata. Okay, so to close, the macro climate has changed a lot. Okay, this is real change, you know. Don't believe it's gonna go back to 0% interest rate. Actually, I don't think there's any chance of it happening. Yeah, the Fed is already saying that I'm going to jack it up until I feel inflation is under control. I'm just going to leave it there. Right? So they don't even expect them to lower it. The optimists think they will lower 0.25 by end of the year. That's all. Right? The pessimist think it's going to just stay like that for a long time. Right? So this means all these readjusting of valuations is quite permanent as markets can be lah, okay, right? But it's quite permanent for now, right? So it's up to the investor to adjust, right? But we do think that for early stage investing, it's probably still okay, right? Because we are already investing at the floor, right? The company is worth 3 million, 4 million, 5 million. We put in our check. Even if the ultimate exit is no longer 200 million, but it's 100 million because all re-rated, right? You still get very good returns for what you are putting in. Right, so that's our logic. So that's why we are carrying on to invest, but of course we don't want to overpay anymore. Right. And then there's always another deal, right? So just keep looking at the deals that come and then we see which one that really attractive. We really like the founders because it's still founders first. And then the terms will not be that bad, right? If this climate continues, I think the terms will get more and more favorable for the investor side. So that's all I have. Before we go to Q&A, I'll pass over to Xiaoning. She'll share a little bit about AngelCentral. More for the benefit of the non-members. Hopefully you will join us and we can all learn together. And then after that, we'll take whatever question. I'll ask Tengmo to come and we can take whatever questions you have.
Okay, so hello everyone. Actually, I realized most of the faces are familiar faces, so I'm not going to do my marketing spiel too much. But I just hope that you don't see this as a really negative sentiment towards us, because I think it's actually more the AngelCentral style. We are not the one to hype it out and say, hey, it's an exciting space, let's go in. I think the AngelCentral style is more of angel investing is an asset class that you need to consider if you want to build a legacy bucket in your portfolio. You know what I'm saying, right? Because it cannot be something this is exciting and let's go throw money in together and let's go to join a joyride. Because the thing is, you need to be responsible for your money because it's meant for your next generation. So that's actually the way that I think of money and the what's the word lah? And the guardian to make sure that my 4 boys got the custodian. Yes, sorry. Make sure my 4 boys got education and got school fee, right? So I think that's the style that we want to make sure that our members understand. Angel investing is good returns, 20, 30 moonshot possibility, but you need to do it responsibly. We are not joyride lah. So Serena actually has promotion campaigns that are going on to share with you. But I think the idea is our style is very much of education first, learning first, learn as a group. And through the syndicates, we bring our resources together. We leverage on each other for learning. In fact, online, Lance and I were just chatting about one of the deals that we were talking about. Certain VC style, I think Dashing already highlighted certain style. The Singapore VCs are still good. They were still, they don't write down, but they're realistic. We recently have a case where the VCs actually hype out the number, tell the startup that you can take this kind of number, but they put in a check that is so minimal, barely, not even 5% of the round. So as an angel, we are supporting the founder. We have to help the founder read the scene. So our job is to guide, to support and all this. So it's actually the style. So for people who are looking to do angel investing, join us, so then we join the do the right together to support the founder. For the founders in the room, it doesn't mean that no chance of fundraising for this period of time, but I think it's just really very much of what's your personal goal. I think I see 3 to 5 founders, 3 to 5 pairs of founders a week on average. My message to the founders is always the same. You do not start a business to fundraise. You start a business because you want to fulfill a dream, a challenge that you believe you are the best person to solve it. So don't fall into the trap to feel that fundraising is the only way. Actually, financing, more than one way. Using your cash flow to finance your business actually is the best way. Okay, so anyway, to drive our membership, talk to Serena and talk to Take More and ask. And then actually we have a lot of members here today to get down to share the view. But I think we a bit more old-fashioned in the sense that our average age, not old-fashioned, our average age is a bit higher, more than 45. But I definitely, we're still very young at heart. That's why we are supporting startup. We learn through startup. Okay. So Take More, Sarah, please everybody share.
Okay, thank you, Ning. Yeah, so we can take Q&A. Any questions the floor has, we're more than happy to answer. Yes, yeah. Oh yeah, it's definitely execution. So okay, so don't get me wrong. Yeah, I realized Ning is hinting to me that it sounded too pessimistic. It's my style lah. Okay, I like to give all the information and all the thought process. I'm not pessimistic. Otherwise, I won't be investing so much money, right? You got to look at what people do, not just what they say, right? Of course, if what they say and what they do is aligned, that's the best, right? But sometimes people say one thing, do the other thing, then I'll follow what they do, not what they say. Okay, but that's a side topic. Yeah, so yes, it's definitely execution related. So when we invest so early, right, the thing that makes the difference is how the founder executes as a team, how well they grow their market. So like I mentioned, right, if I start with just 500,000 revenue, even the worst recession, I can grow to 5 million revenue one. Even in the worst recessions, you will see people build big businesses. So our startups are no different. So the ones that fail, of course, you can, there will be sometimes it's attributed to because COVID, right? COVID caused more problems. Maybe inflation caused more problems. Maybe their sector is travel related. So of course that causes more problems, right? But it's also a lot of it is also the team itself just couldn't pivot fast enough, couldn't execute well enough, right? So it's seldom the macro that causes a startup to fail. It's the startup's inability to find either a pivot or inability to scale if their sector don't need to pivot actually. You know what I mean? Yeah, that's why we have so many that actually grew revenue 20% last year. At least 20%. A lot of them still grew very well. So don't get me wrong. So what has changed is that remember the triangle? What has changed is the deal term side, we must be a bit more careful because the final exit has all cut by a lot already, at least on paper now. But you never know if 5 years time it could be different. And that's the other issue, right? When we invest in startups now, for example, we are not going to get exit till at least 5 to 10, 15 years later. So if you fast forward to 2033, right? Probably for the market is a totally different market again, and the valuations could be crazy again, right? So I rather just focus on picking very good founders. They can execute well, they can carve out a niche for themselves, and now the market is like that, right? I look for founders that are a bit more grounded, that really want to build a good cash flow positive type of scaling business, right?
Shing, just now during the AngelCentral data slide, right? You have one. You mentioned that the founders' quality are about the same. So how do you measure that?
What do you mean founders' quality about the same?
There was one slide on AngelCentral data over the past couple of years, where you mentioned that
no, it's not measured. Like it's like because the filtering, because AngelCentral is interesting in the sense we don't have no analyst one, no. So it's just me, Ning, and Tengmo who are filtering. The 800 is filtered by the three of us because this is our job, right? Yeah. So when we filter, we meet every week. So we actually will just get a sense among ourselves, right? How strong are the teams, the people, right? Over the years, you just see more and more quality people, interesting people coming out to do startups, right? Yeah. But there's no qualitative thing, right? A quantitative thing. Yeah, that's what you're asking. Yeah. Temo, you want to add?
Yeah. So the question you highlighted lending businesses as something to think, be a little bit more cautious about in the current environment. Why did you highlight that particular business? Because intuitively you would think in the past, cost of funds low, so people lend out at a slightly higher rate. Now cost of funds a little bit higher, or your internal hurdle is a little bit higher, but you're also still going to be lending out at a higher rate. But correct. So what's the structural?
No, I agree with you. So by right, we will pass it on, right? Yeah, but so I'm not saying that I think it will fail, it won't work. I will just be careful on that space because I don't know how it plays out. at the end, because the end should have a demand drop if the cost gets too high. Right? I mean, okay, like last time, if I want to, for example, if I'm factoring my invoice, maybe I pay 7-8% last time, right? I'm the end customer, I'm the supplier. But if now I have to pay 14-15% because all the costs have cascaded up, then will I still factor my invoice? I think some people may not. So you will be facing a demand drop at the real customer end. Then how does that play out with all the assumptions they have? I'm not so sure. I'm not saying cannot do, because I've seen some earned wage access. They claim to be able to do 40-50% on every dollar that they have in their balance sheet to lend out. Yeah, but the model is different, right? So I'm not saying cannot do. I just saying be very careful and dig deep. Don't use the old world whereby the first fund they did it was the cost of funds was very cheap. Like the buy now pay later. A lot of problems now, right? Yeah. Yeah.
I mean, just give you a simple example, right? Factoring. The SME need the cash flow faster than the payer who maybe pays after 90 days or 120 days. Right? So what's the cost of capital to get the money back? Right? So previously when the lender, the cost of capital maybe 1 or 2%, even 3%, they can offer 15%, right? But now it's 6%. By the time they charge it, it's 20-25%. So you think about an SME, if your margin is 25% and you pay 25% for factoring, you got no money. So the economics change significantly, right? No, it doesn't. Right? So just think about Helicap. It's a fund in Singapore. When the interest rate was low, they were returning the investors of the capital 6%, and the company makes 10%, which means that the cost of capital maybe whatever percent, they're selling it at 16%. But now the cost of capital is 6%. If I get 6% for Helicap, it's not good enough for me. So if I want 10, and then the company takes another 10, it's 20%, you know. So the cost of capital is challenging. And Helicap, the last year, didn't have any failures. They clearly say that there's no failures. But definitely there is opportunity for failure. If you lose your failure, for every dollar you put in, and you're expecting to get 15 or 20%, and you fail, you need to earn 5 times to break even, you know. So the failure opportunity is much higher now.
Yeah, default risk, right? But don't hear us wrong. I never rule out things, right? I'm just saying that this specter I will look a lot more carefully, because there's some inherent, and there's also Temo also didn't go into, there's a matching issue for a lot of them, meaning the duration they lend out versus the duration on the back, right? And if interest rates keep moving and are very volatile, it actually creates even more complexity into their business. Right, so it's tricky. I'm not saying don't, because I looked very carefully into earned wage access. Actually, I like it actually for some of them, right? Because they are, with a dollar, they are able to generate almost 40+%, right, in interest, and the credit risk is on the employer. So if you pick great employers, you should be fine theoretically, right? I can go into that later, but yeah. So it'll be very interesting to see how much they have to pay, right? Because if junk bonds are yielding 8, then I expect it to pay me more than 8, right? Right, and I'm the cost of capital, tricky, yeah. Okay. Any other questions? Yeah.
Okay. The question is, as an angel investor, how much influence you have over the founder, or in the decisions that they make, or if they want a VC to come in, if you feel that it's not the right thing to do.
I can try first, then maybe if you all want to try, or Temo, you want to try first?
Yeah, I think it depends on the relationship between the angel investor and the founder. Actually, the good founders, actually, they don't need a lot of help. But what they do is getting some insight from you, or maybe you're asking the right question, which asks them to re-question their assumptions, and then they work on that. Right. If the founder needs too much help from me, then I worry, because I'm not always going to be there for them. Right. And as they grow, and the successful founders are what we call learning agility very, very high. just think about if you're creating a company, which initially you're dealing with 10 customers, 100 customers, 1,000 customers, 10,000 customers, the ability for you to scale your capability, your management style, right, your scaling, you need to be able to grow very, very quickly. So we like to find founders which can grow quickly and flexible and be able to understand and have a pulse on the ground, right? These founders, actually, they don't need a lot of help.
I think Timo covers it. We as angels, I mean, this is more in our master class because today is just an update of how we see the climate, what has changed, right? Yeah, but generally, angel investors, we seldom are even on the board of the startup, right? So very little hard influence. Any other influence is all soft, right? Yeah.
The other comment I would make is if it's very, very early, then our insight of what model works, what doesn't work, what we've seen in the space may help the founders to figure out their problem solution fit. That's a lot of work we've done, very, very early founders. Right.
Okay. Yes, yeah.
So, being a ex-founder, again, a second company that I founded, being an investor, one of the things I tell founders that I wouldn't say advice to, but I give some inputs is at the end of the day, everybody's journey is different. So take the input, strip it out if you want, but whatever it is. But there's no control likely.
Actually, also to chime in a little bit on this, I think it's a general, I mean, if I see it from my own journey along the way, I realize that for some of the angels that we see in this part of the market, I mean, it's a bit of a tricky lah, because a lot of angels given the age that we have, we feel that we know better than the founders. So we actually want the founders to behave in a certain way. Not to mention that I have a 21-year-old son who actually feels that I don't know what they're doing, right? So the thing is, I think it's more of trying to nudge them, trying to be a sharer, because our belief is as an angel investor, we don't own more than 2% of the cap table. So on a personal resource basis, my time, my money, my wallet, I don't want to spend more than 2% of my time also. So the thing is, I will nudge, I will be a sounding board for them. And that's why we look for founders who can learn and very agile. If a founder, on the other hand, wants that much help, right, then I will be like, die already, we chose wrongly. On the other hand, if let's say the angel going in thinking that I want to own 30% of the company because I put in $50,000, then I think there's a big alignment mismatch. So it's more of where you stand. There are angels in the market like that. It's personal philosophy at play. So individual angels got to decide for themselves how they want to evolve that style. To answer one of the online questions from Eliza, can you share a bit of your experiences investing into startups and versus funds? Will you continue to do both? The truth is, we run out of our allocation for funds. And like Dashing said, the funds are not giving PPI, so we cannot recycle now. But we will still continue to do angels because, frankly, our own TVPI now calculating because angel is giving us better TVPI. Dashing is the number one, so he will answer.
Yeah. So no. So when this more context because there are a lot of new people here. So when we invested in funds and startups, we actually split and do both, right? So we invest in VC funds. We did Monk's Hill, Jungle, 500, whole bunch of them. And then on the startup side, then we pick lah. That's why we end up with 48, right? Actually, the thesis was that the funds are later stage. Series A, we are doing seed, so we feed into them, right? It kind of worked pretty well. Not so much the feeding, but the fact that we end up having exposure on the whole spectrum. And then actually the VCs do refer some pretty good deals to us, right? Because they see earlier deals, then they send to us. And then also for our founders, at least we can refer them to the VCs and they will pay attention because we are their customer, right? We invested in their fund. So that works. Actually, return standpoint is pretty even, I have to say, because if we strip out their management fee, because they have a 220 fee, right? VCs. So if I strip out their fee, right, then it's actually the same as our angel portfolio. But I think Ning feels that our angel portfolio is stronger because we are more active in writing down, right? For us, if we think not working out, we actually write down to zero in our own books first, right? Before even really close down. The VC will never do that until you're really going to close, right? So there's a bit of a difference there, but I have to say the VCs in our region have all done very well. Most of them are pretty strong in their numbers, right? Yeah, so will we continue? Yes, if they start to return us money, then yes. Yeah, so the weakness in our ecosystem, I think more and more people are saying it, it's very clear one. The weakness in our ecosystem is there are not enough exits, right? So the people who have put in money, right? I mean, we put in 8 million, it's quite a lot of money, right? We see very little back, even up till now, right? And I think the truth is, we talked to quite a few American guys. They actually told us very realistically, right? Maybe even 15 years to get your exit, right? Which means the last dollar, everything pay you back, 15 years, right? So most of the funds that we've done are still barely in the 10th year right now. So it does kind of gel, like Ninja IPO in 2025, then Monk's Hill Fund 1 will return everything plus profit already, right? So hopefully that happens, right? Yeah. Credivo IPO, then Jungle will return everything already, right? Yeah.
Actually, I do have a different problem. Okay, because my goal is to get more than 10 or 15% of my portfolio money into startups, right? But just think about it, if I'm fully allocated on 10% of this money, and my TVPI is actually quite strong. My TVPI is like 3 point something times, like close to 4, right? But my public equity and my bonds have come down at least 20%. So suddenly my ratio is like 30 to 40% in this space. So that's the different problem that I have, right? So I'm still going to look at deals. I'm going to look at, well, my sense is at this space, at this time, right? The valuation is lower, right? In fact, last year I doubled down on my private equity funds because they will ride through this cycle because their horizon is 7 years and 10 years. So I think they'll outperform the current public market, right? So I will still look for very good deals. Why I can get good deals, I think the valuation over time will come down. Because now speaking, in fact, today I spent a time with a very good founder this morning, and I say I cannot support your valuation. And for the first time, for a long time, the guy said, "Okay, I listen to you. Tell me what valuation you can get." Right. So that's unusual in the last few years. Okay. The other thing I think the 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 laying off of all the tech talent, many of them will come into this space and be founders. And these people are executionally strong, some of them. They've got vision, they've got capability, and they can pull very good talent into the company. Right. So these companies, I will always look for people which are like that. So I will still invest, but I need to figure out, right, my portfolio kind of ratio because it's completely screwed up now.
Okay, so how we do that? Maybe you can share. So actually, we I told you this. How we handle it is we always put a book value. We do not write up. Yeah, I don't write up the startup piece at all. Even the VC piece, I don't write up. You tell me it's worth 3 times, I still put it as 1 time only.
Yeah, even if I don't write up, because my public equity has come down more than
That one different
20%.
problem. There you go.
Right.
Yeah.
So therefore, my 10% is already 20%. Right? Even you don't count, you don't add it out, right? So my ratio is a bit screwed up. I need to explain to my wife.
Okay, we have another question online. Maybe this is a bit different, but there are people doing this. So this lady Diana is asking, is there a way to structure consulting hours as an angel investment? Meaning that, you provide X amount of consulting and mentoring hours to whether tech team, marketing, whatever, help with fundraising, whatever. And for that, you get a stake in the startup. That's quite common. It can be done, but it's just, hey, take care, guys. Yeah, you just have to work out the agreement with the founder, right? So the founder would sign a consultancy agreement with you to say that, hey, maybe you commit 8 hours a month for 1 full year, right? And maybe have some deliverable written down in that contract. And then at the end of it, they issue you X amount of shares that is worth how much? Huh? That's quite normal. I don't think there's any issue. Yeah. I hear of them. I personally don't do it. So we always put money down for us, right? But I have had deals whereby the founder want to meet me every month. Really just want to meet me every month. He thinks I'm good luck or something like that. So we invested 100K and then I met him every month. Then he issued us some extra shares like a consultant. Yeah.
I wouldn't support too many of such consulting agreements.
But actually, in the market, you have a lot of people offering such services too, where they don't put money in. So I think it's really a negotiation between the founders and the angels. But in this case, I won't call them angels because they're actually more, I don't know what's the term, consultants. Yeah. So from founders' point of view, I think it's really just buyer beware. You really need to manage it. But for angels who offer this, my take is, I actually did 2 deals like this, but it's for companies that I have put money with. I mean, personally, I feel that I don't think I will provide good services too if I didn't put money with them. It's more psychological. Yeah. So Diana, I hope that works. That helps. Any questions from the floor? If not, we can wrap up and enjoy the coffee and tea. Okay. Oh, there's chocolate too. All right. Thank you, everyone. Thanks. Thanks, everyone online.